Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. Have you ever wondered if you could set your kids up for success and thought, I wish I could be doing more? Well, today's episode is going to be all about preparing the next generation for greatness when it comes to their relationship with money and wealth. Today, I am privileged to have a founder of Future Money, Phil Barrar, as a guest, and he is going to be telling us all about the future of money. Phil, welcome to the podcast.
Hey, thanks for having me, Melissa.
Let me get the phone hung up in the background. Sorry about that.
No problem.
So tell me a little bit about why generational wealth, and we can talk about what that means and what that is, why generational wealth matters to you.
Yeah, absolutely. So maybe a little bit about my origin story. I've been a fintech founder for over a decade here, but prior to this company, I previously started a Roundup to Invest platform. We were the third largest Roundup to Invest platform globally, and we were helping people start saving and investing for the very first time through goal-based investment platforms. And one of the things that we saw was people like this concept of investing for kids. They saw that this was a great tool to help bridge some of the wealth gap challenges that people are facing, and specifically the challenges that we're facing today, where the first generation has to be financially worse off than our parents' generation due to wage stagnation, home affordability challenges, inflation, rising education costs. Living out the American dream feels out of reach for most, and we had this really unique insight that people were trying to bridge those challenges with investing, and that's what brought us here today.
Terrific. Maybe we can debate whether we're the worst generation in the future, because I feel like, I don't know about that, but I'm totally loving the conversation about building generational wealth, feeling the empowerment to have financial independence and also pass that along to the next generation. And by the way, so the Roundup fintech technology is when you have kind of automatic investments with the loose change kind of in your portfolio. Is that right?
That's correct. You'd link your credit and debit card. Every purchase you made, we round up to the nearest dollar, would take that spare change, virtual spare change, and put it into a fully managed investment account.
So one of the things that I love, and I think will be enduring in this conversation, is that in the wealth management world, it's many of the people like me, and I'll even blame myself too. We are not built for scale, right? Like, we're not built to serve 1,000, 5,000, 10,000 clients. And kind of because of that, and because of the economics of running a company like ours, you need some wealth to begin with in many cases in order to get access to services. I really work hard, and this podcast is one of the outcomes to make sure that our information, advice, and kind of knowledge is accessible to broader populations. But both with your first startup as well as what we're going to talk about with Future Money, it sounds like you are providing access to people that don't need their first $1 million to make the next million. Is that correct?
That's correct. We're helping families who may not have an investment account set up, or if they do, they may not be. They consider themselves an investor, not a trader. They want to go in and make sure that they're doing the right things for their families, but maybe not necessarily sure, is this the right account, or am I putting in the right amount every single week? So my whole career has been dedicated to building financially inclusive products that help, through the use of technology, make products more affordable and more accessible for everyday Americans. We know that there's a massive wealth gap that's been closing through the use of technology, but our goal is to help people get started and feel confident about their money. So I was reading a Charles Schwab report on investing for women recently, and it said that 90% of women who are investing feel like they're on track for their goals, which is incredible. And I would say probably more confident than if you were to survey men for the same results. But 85% said that they wish they started sooner. I think it's half of millennial women start investing after the age of 30. So getting started early is the most important thing you can be doing towards that wealth building journey, and helping get access to great platforms like yours.
Well, before we dive into the products that you're providing or the services and technology solutions that you're providing, can you tell me your definition of generational wealth?
Yeah, absolutely. So that's a great question, and not one that people ask me very, very often. But what
Sorry to
we're
put you on the
looking,
spot.
no, it's great. So for us, the reason why I started this company was to be able to provide my kids with financial security. I know that the future is uncertain, and that life can take you in many different ways, and to know that you have the peace of mind that regardless of what happens in your life, that you'll be able to live out your best goals and milestones that you're looking for is really important. So for me, my concept for my family building generational wealth is setting enough money aside so that regardless of what happens in my kids' lives, we know that they will always be okay.
I know that that is a growing trend is to really have accounts and money set aside for kids. Now, we've seen it over the years, certainly, but it's something I think I read a New York Times or Wall Street Journal article about families that were creating accounts for not just for a college fund, but like first 20 years out of school fund and things like that. Um, I would also add for those of you listening, and you can tell me what you think, Phil, but um, access to the concepts of money, access to feeling that money is inclusive to you and feeling prepared to deal with money, that is a gift that is generational wealth because one of the important prerequisites for feeling comfortable, confident, and not shameful about money is to have money discussed in the household, have feel that you are not being excluded from kind of the pools that create wealth and things like that. So I think you're doing a double service as we're getting into your products, and that you are both able to provide accounts that can build wealth, but you're also providing conversations and education and normalizing conversations about money, which is just something that we both know, I would assume, and I won't put words in your mouth, is woefully inadequate as a culture, especially for those who don't feel like they grew up with wealth.
I would completely agree with you, and I would say that a lot of those financial literacy foundation blocks come from the parents, and they come from the conversations. And you're either getting really great advice on how you should be managing money and thinking about money, and I've heard great things where parents have helped kids by forcing them to save to buy their first car, and then when it came time to actually buying the car, they're like, actually, no, I'm going to buy it for you. Take all that money, put it into your retirement account, and here's how it works. So, teaching them the actions of going through and learning the habits of saving and investing. And I've also heard horror stories where people are like, "Oh, you should buy your first car, just put it on a credit card," and
That is a horror story. Yikes!
it is a
That
horror story. And
spooky
when you
season
look
on that one.
and you look at the extremes of both of those pieces of financial advice are both coming from the parents, and one person is set up for success and the other person is set up for starting in the negative and in a really difficult position. So I think that this is a great opportunity to help parents guide their kids and having fruitful conversations with their kids about the value of money, and how to be able to start off on the right foot.
Okay, so you knew that you wanted to make sure that your kids and families like yours were preparing the kids for financial success. And in fact, you have a brand new baby, so you were preparing for this in advance. Kudos to your family values and culture that you were working on things this way. But then you pivoted from your first startup to Future Money. And there are actual, kind of services within this financial technology, fintech software. So give me a little lay of the land for Future Money. What are you actually offering?
Yeah, absolutely. So today, Future Money is the most comprehensive platform to access tax advantage accounts for families in this country. What we're trying to do is take these very sophisticated account types and make them simple and accessible for everyday Americans. We think that if access is a barrier to getting started, what can we do to be able to remove that barrier and make it simple to start? And so we've used a simple mobile application or web platform for you to be able to go through, state your goals, whether it be saving for education in 18 years or saving for retirement in 65 years and everything in between, and then picking the right account types to help you get there.
So I want to give a couple prerequisites before we get into the nitty gritty and nuts and bolts of the accounts and the products that you're providing. First of all, for those of you listening, make sure to put the oxygen mask on yourself if the plane is turbulent before you put it on the kids. So if your finances aren't stable, if you're saving for the kids but not for your own retirement, I want you to also listen to our episodes about yourself because it is really important to have balance in and I love these concepts. So that's prereq number one. Prereq number two is we're going to go into a conversation about some specific investment products. And as a wealth manager myself and an investment advisor representative, I just need you to know that you should do your own research. We're not giving a recommendation. I'm sure Phil would agree. And so we're going to get into some technicals, but you need to, kind of go in eyes wide open and do your own research. Okay, so now let's get into some of the products that you're offering. You mentioned that you can save for generational wealth in tax advantage manners. I'm assuming some of the accounts that you're thinking about that provide advantages tax wise are perhaps Roth IRAs. I know that's on your website, as well as 529s. Any other account types that I should be aware of that you're offering?
Yeah, absolutely. So when we think about tax advantage accounts for families, education, utilizing a 529 account is a great place to start. Again, very specific to your own individual goals and whether or not the 529s are the right account type for you. But for a lot of Americans, they do find that this is a great place to start. Custodial Roth IRAs are incredible if you have earned employment income. Typically, these have only been historically available to people who do. So either you own a business and you can hire your kids, or you're a high net worth individual that put together a complex tax infrastructure, or you're a child actor or celebrity. So typically, these have not been historically available to many Americans, and we're trying to democratize that access today as well.
So I
Um,
will pause you right there. So many, if not most of the consumers working with Future Money today, you've shared with me, are maybe Gen Z, younger millennials where their kids are under the age of 10 or even perhaps 5. My son is 16, so he just got his first job as a 15-year-old that was like, kind of W-2 income. He's come to the office for a couple things, but we don't have him on the payroll. And so if for him, because he hasn't, reported income, had earned income in the past, then the first time he became eligible to contribute to a Roth IRA or an IRA was last year when he was a 15-year-old and he had his summer job at a park and, he made $2,000 so he could contribute up to $2,000 into a Roth IRA. That is the first kind of age of eligibility for traditional retirement accounts.
Absolutely, and we highly suggest that people, as soon as they do become eligible, to start utilizing those accounts, because the years that you don't use it, you lose that contribution room. So it's a great opportunity to get started early, and congrats to your son getting started in
Yes.
the workplace.
If you're a listener, you have until next tax season. If you've got a kid that put away money, and I think an excellent, kind of recommendation is to perhaps have a matching program if you have room for it. So if they put in money, you'll put in money, kind of get a lay of the land and set up a target up front. But it's great to not just have the money magically plop into the account and be like, oh, I got to spend it all. And then mom and dad kind of paid the retirement bills. So keep that in the back of your mind. We have a whole episode about minor Roth IRAs, but let's get further. So that does exclude. So many people are like, oh my gosh, Roth, I'm in, let's go. And it's like, well, you do actually need earned income, and most 5, 6, and 7-year-olds are not doing actual work unless they're, a cover model or they're an influencer, which, crazy things have happened.
Absolutely. So maybe just out of curiosity, where did you want to try the conversation from here?
Yeah, so I would love, let's go into one of your flagship products is the Junior 529. And so that, or Junior Roth IRA, I should say. A trademark product. Am I saying it right?
Correct.
Okay. So you have intellectual property, a trademark. This is a pathway when you do not have earned income where over time you can end up with Roth assets. That's the way I would say it, but you tell me how you would say it, Phil.
That's a great summary. So one of the things that Future Money is most known for is our Junior Roth IRA product. And as you mentioned, it is a trademarked account that we are putting together, but the accounts are comprised of multiple accounts under the hood. So the first one is a cash account. Typically, you need an account minimum to be able to invest into a 529 account. So, in order to provide early access and recurring deposits, money aggregates into a cash account until you hit the account minimums required for investing into a 529. Once you hit those account minimums, we then transfer the money from a cash account to a 529 account. While it's in a 529 account, all that money grows completely tax free, and it can be withdrawn tax free for education purposes, or upon hitting certain criteria, you're able to roll over that money from a 529 account to a Roth IRA. So we're calling it the Junior Roth IRA because it is your pathway into being able to make Roth IRA contributions with income that's grown tax free in a 529 account early on.
So, for lack of a better word, you need to kind of age this account in order to turn it into the Roth asset down the road. But with new legislation over the past few years, 529s have liberated the access to leftover funds so that there's a pathway to put a certain amount of 529 assets, whether they were intended for college or in the case of this program, perhaps they were really earmarked to become Roth assets from the beginning after a certain period of time. How long do you need to wait to make those assets Roth assets?
Yeah, that's a great question. So through this Secure Act 2.0 that came into effect January 1st of 2024, you can now migrate up to $35,000 from a 529 account to a Roth IRA. In order for that to be eligible, the 529 account has to be at least 15 years old. The contributions into that account needs to be a minimum of 5 years old. And then the rollover needs to hit all the relevant criteria for a Roth IRA in that calendar year that you are doing that. So typically, if you were to max out that $35,000 basis, you waited the 15 years, your child hits the age of maturity. That is a multi-year rollover process that you're managing from the 529 account to the Roth IRA. It requires a bunch of paperwork, and sometimes people have had headaches. What we've done is we've automated the entire process using our technology to be able to help families be able to access these tools in the pain-free manner. And that's what we call the Junior Roth IRA product.
I love that because it is very new right now, but it will become more understood and regular over time. One of the things that happened when this first became available was the law was passed, but then you call the 529 companies and you're like, how's this going to work? And they're like, not sure. Like, we'll figure it out as we go, basically. So it's not, it's something that is an aspiration for many, but not being utilized as frequently nowadays because it's only, less than 2 years old.
Absolutely. And
So, oh, go ahead.
we're seeing that across multiple account types. So the 529 to Roth IRA rollover is a great example. The one that we're all in the middle scratching our heads and trying to figure out is the new Trump accounts that are coming out next year. So
Are you
um,
planning to have those products available for the Trop accounts or TBD?
we absolutely, yeah, we absolutely are. So maybe just to take a quick step back, Future Money is a registered investment advisor. We are SEC registered across the U.S., available in all 50 states, and we don't actually touch the money. We work with trusted custodians to be able to manage your assets and invest those assets for you. So as part of that process, we've built a multi-custodial model. So we're working with Fidelity, Schwab, Altruist, BNY Mellon, Pershing, and a handful of states and different 529 accounts. And through this multi-custodial model, as soon as one of these custodians offers the Trump account, we will be one of the first to be able to do so. So we're very excited to be leading the charge on that front, in combination with some of the incumbents that have built so much trust and credibility in the market over the last hundreds of years.
Just financial professional to financial professional, it's going to be interesting because when you think about an account for every child born during certain years, which you probably know this off of the top of your head, and I have talked about it in the past, but I don't have the One Big Beautiful Bill Act completely memorized from the summer. But it will be available for kids in what years of birth?
Yeah, so the pilot project is slated right now for kids born between the years of 2025 and 2028. The way that's drafted at the moment, they will get a $1,000 account opening bonus into a Trump account. Those $1,000 account opening bonuses will be invested in an equities type product with a very low management fee as prescribed by the government. And those funds cannot be touched or utilized for the first 18 years of your child's life. So once they turn 18, they can start taking a look at what is the best way of managing it. And these are currently tax deferred accounts. So the money will grow tax free, and then you'll pay the taxes upon the use of capital, depending on how the capital is used at that point.
It'll be really interesting because these, I don't know if any of you listening have health savings accounts, but they're also, kind of a newer quasi investment account, but can also be kind of a pool of money. And because you just add a small amount every year and the Trump accounts are going to be even smaller, it'll be an interesting cohort of companies that choose to do them because they know they'll have many eligible participants, but also those accounts are going to be $1,000 and you can't, kind of nickel and dime people. So technology is really going to need to be those custodians' friends. And obviously, Phil, you're anticipating that as you kind of get ready for whatever 2026 has to offer.
We definitely are, and today, future money is available to consumers across the U.S. through our technology products. But future money also offers a product for advisors to be able to offer these to their clients as well. So sometimes these accounts come with headaches, as you mentioned. Managing these small dollar accounts requires multiple hours of admin per account per year. Sometimes you make little to no fees, and comes with regulatory complexity and risk. So any financial professionals who are interested in offering that, Future Money has an entire program dedicated to empowering you to be able to do so, and retain that relationship without managing the overall burden with offering these accounts.
So you're creating, you have plans to create the Trump accounts. You have the pathway to Roth with the Junior Roth, which is a 529 to Roth pathway trademark product. What other types of accounts are you offering or planning to offer that might be accessible or interesting to families looking to build generational wealth?
Yeah, absolutely. So we do offer 529 accounts as a Junior Roth IRA product, custodial Roth, the Trump accounts coming soon. Then lastly, a taxable brokerage account is an important tool in everyone's toolkit. It provides the most flexibility on withdrawal, and there's a lot of advantages towards one of these taxable investment accounts. One of the popular tools that you may have seen in financial technology platforms is a UTMA or UGMA account, Uniform Gifts for Minors Act or Uniform Transfers for Minors Act. So these account types are taxable brokerage accounts in child name. The benefit being you pay the child income tax rates versus the parent income tax rates. The downside being the child gets full access to these accounts at the age of maturity. And we've heard horror stories about parents putting money aside for kids for their education or for their wedding or for a down payment on a house. And their children may have used the funds more irresponsibly than the parents would have deemed at that time. So, what our alternative to doing that is we put together taxable brokerage account in parent name segregated from their other assets with the child listed as the beneficiary. Now, the benefit of doing it this way is twofold. Parents can maintain full control over the accounts for as long as they want. They can use their lifetime gift allowance to be able to gift the account in kind from the parent to the child whenever they feel like it is the right time to do so. And then lastly, from an estate planning perspective, if the parent doesn't gift the account before they pass, there's a step up in basis on that transfer that happens. So there is a minor tax advantage and tax planning component, but more importantly, provides full control for the parents to deem the money that is set aside for the kids, how's it being utilized and what goals is it going towards.
That's terrific. I would also concur that saving in taxable assets provides a lot of flexibility, regardless of the structure. And I've certainly seen some of those horror stories on UGMAs and UTMAs. I also just find, well, here's a horror story. Depending on your perspective, um, someone I knew in college, grandma had gifted an inheritance outright to minor child. He reaches the age of majority. So, for reference, that's typically 18 or 21. The money's in an account that's completely controlled by him, meets a new girlfriend. They are engaged very quickly, within weeks, if not months. And then the wedding is planned. The wedding's $100,000. Half of the inheritance is gone. Marriage lasts 12 to 24 months. And it's just like poof, the money is gone. And I think that there's something to be said for, kind of allowing the prefrontal cortex to mature before you have access to large pools of funds. But also, if you're thinking, you're kind of playing the long game when it comes to college financing and things like that, money in the parent's name or money in a 529 is looked on much more favorably with a financial aid FAFSA than money that is directly owned by the child.
100%. And one of the great things with the FAFSA improvements over the last few years is money held in grandparent name is not deducted against that as well. So if grandparents are pulling any of these investment accounts, 529 accounts for their grandchildren, it's even more favorable from a financial aid perspective as well.
I'm curious about the beneficiary designation on your taxable accounts that are kind of earmarked for the kids. Is it going directly to the kids? So if mom and dad unfortunately pass away during lifetime, then it has kind of the same access to funds at 18 or 21, or is it in trust, so that there are instructions that might delay till, closer to 25 or something like that?
By default, it's set up as a account that goes directly to the child as soon as the parent would ask. We're hoping with the mortality rates that most parents are living past that age point, and that's not something we're going to have to come across very often. But to the extent that parents have their own wishes and want to plan for that, something we can totally accommodate for putting it in trust and managing it. So by default, it is fully flexible, but we can put in those restrictions as needed.
Yeah, if you're playing the odds, then most people won't have the challenge of dealing with that. But if you want to be extra safe, then oftentimes that's one of the reasons that when you're drafting your estate plan, which includes will, power of attorney, healthcare power of attorney, living will, that a trust is often utilized or advised by estate planning attorneys for people with minor children or children who have recently reached the age of majority. The other thing that I've noticed though with UTMAs is that they tend to they're small accounts. They are often, kind of a tag along on the statement at the brokerage. And, sometimes we have a 30-year-old who still has this account that they really can't do anything with because they haven't sent in the old school paperwork that needs to update the account to the ownership of the kids. So you both have the kids that use it too quickly and the kids who never use it because it's just this tag along statement that they don't really know what to do with it. So if you do have a dusty or a dusty UTMA or UGMA, you may want to just start the process of getting things updated to your own name because you are now the owner. And it's really difficult to do things when mom and dad are still listed and you're 27 and it's an account built for somebody under the age of 18.
Absolutely. That's great advice. And one of the reasons why we don't offer it in our platform today.
Well, when you have started this work, I want to leave with just one question, which is what surprised you and perhaps gratified you in terms of starting to, kind of democratize generational wealth. I think that generational wealth has always been considered, being a decamillionaire, having $10 million and setting your kids up to be trust fund babies or adults who, each are growing to their own $10 million. But I love the concept of generational wealth being more inclusive. So with the work that you are doing, and I know you're building something that is near and dear to your heart, what has surprised you? What has been rewarding? And, kind of what are you hearing from the consumers that are using your software?
Yeah, absolutely. It's a great question, and a couple answers. But the first one, Prudential just released a survey earlier this year saying 80% of prospective parents think that retirement savings should start at work. So this is a really interesting time to be building a product like this. The current administration has said investing for kids is the most important topic for our generation, and one of the best tools in the toolkit. So it's one of the fastest growing segments, and it's really exciting to see people planning ahead and thinking about this in a great way. One of the scariest things we've heard through customer discovery, one person said, I'm doing this in place of buying term life insurance.
Mm,
I don't recommend doing that
stop.
at all, but that was the approach that they were taking. So obviously we gave them the advice that they should go and take a holistic look at all their financials and thinking what's the right plan for them. But the peace of mind that's coming from a platform like this and the what is helping parents feel comfortable about the future for their kids is really exciting, and everyone has their own why, which is great, whether it be hospice care workers seeing end of life coverage and not wanting the same thing for their families, or survivors of domestic abuse and financial manipulation saying that they never want the same thing to happen for their own kids. It is incredible to hear the stories on why people are opening up these accounts, and I give them huge kudos for taking a step forward in the right direction, helping their kids be set up for financial success in the future.
I mean, that's one of the gifts being sitting in the roles that we have, right, Phil? Is money is so personal. It can be such a weight and an anchor when people's relationship with money is tainted, traumatized, and turning things into um, a perspective where you feel like you're constructive, you feel like you're improving over time, you feel like you're taking care of the ones that you love. And on a women's money wisdom podcast, women are so communal in wanting to ensure that their flock is being tended to as well as themselves. And so apps, tools, and technology like yours is so important. And congratulations on your success.
Thank you very much.
Thank you for listening to the Women's Money Wisdom podcast. If you found value in this episode, the best way that you can support the podcast is to forward an episode to a friend or leave a review. Go to proplan.com and the podcast link to get all the resources and links mentioned. This presentation by Pearl Planning is intended for general information purposes only. No portion of this presentation serves as a receipt of or a substitute for personal investment advice from Pearl Planning or any other investment professional of your choosing. Copies of Pearl Planning's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or on our website platform at pearlplan.com. The information that we share is meant to educate and inspire, not serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, the opinions shared in this podcast are Melissa's own and those of her guests. They don't necessarily represent any organizations with which Melissa is affiliated. For more important disclosures, please go to our webpage at pearlplan.com.